Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Immunitybio Inc. Annual Report. Immunitybio Inc. offers a range of innovative biotechnology services and products. The company's platforms include cytokine fusion proteins, DNA and vaccine vectors, and cell therapies, which are designed to activate the patient's immune system and provide durable protection against cancer and infectious diseases. The company's product candidates include Anktiva, an FDA-approved immunotherapy for treating bladder cancer, and 3-52, a synthetic TLR7/8 agonist. Immunitybio also has collaborations with various organizations, including the National Cancer Institute, Serum Institute of India Private Limited, B1 Medicines Limited, 3 Million Innovative Properties Company, and Access to Advanced Health Institute. In addition to its product candidates and collaborations, Immunitybio services include biologic product development and commercialization. The company's platforms have generated first-in-human therapeutic agents that are planned for clinical trials in liquid and solid tumors. Overall, Immunitybio is a leading biotechnology company focused on developing innovative immunotherapies for various diseases. The list of businesses and services provided by Immunitybio includes biologic product development, commercialization of next-generation immunotherapies, collaboration with various organizations, including the National Cancer Institute and Serum Institute of India, Private Limited License Agreement with 3 Million Innovative Properties Company access to Advanced Health Institute development of cytokine fusion proteins, DNA and vaccine vectors, and cell therapies clinical trials for liquid and solid tumors. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket. The stock price of Immunitybio Inc. has seen significant growth in the past year due to several factors that have contributed to its upward trend. One major reason is the company's innovative approach to developing immunotherapies for various diseases, including cancer and infectious diseases. The success of their clinical trials and the promising results from their research have generated excitement among investors. Another factor contributing to the stock price increase is the growing demand for biotechnology companies that are working on developing treatments for complex diseases. As the global healthcare industry continues to evolve, investors are looking for companies with cutting-edge technologies and innovative approaches to address pressing health issues. Immunitybio's focus on immunotherapy has resonated with this trend. Additionally, the company's strategic partnerships and collaborations have also played a significant role in its stock price growth. By partnering with other leading biotechnology companies and research institutions, Immunitybio has been able to expand its reach and accelerate its research and development efforts. This has not only increased investor confidence, but also provided a competitive edge in the market. Lastly, the overall positive sentiment towards the biotech industry as a whole has contributed to Immunitybio's stock price surge. As investors become more aware of the potential of immunotherapies and other innovative treatments, they are increasingly looking for companies that are at the forefront of this trend. Immunitybio Inc. maintains a market capitalization of $10 billion, broadly in line with the industry peer group. Immunitybio Inc. trades at a lower price-to-book ratio of -18.97 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 227% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Firstly, regulatory environment changes play a significant role in shaping the company's operations and revenue streams. Changes in laws, policies, and guidelines can either hinder or facilitate business growth. Product sales are another crucial driver of revenue growth or decline. The success of approved products, product candidates, and market demand all contribute to the company's revenue performance. Furthermore, customer relationships and retention are vital for sustained revenue growth, as key customers' financial difficulties or changes in business strategies can significantly impact revenue. Financing and cash flow management also play a critical role in driving revenue growth or decline. External financing, such as equity offerings and borrowing from affiliated entities, can either provide the necessary funds to support business expansion or lead to increased expenses and debt obligations. Litigation and dispute outcomes can also have a significant impact on revenue growth or decline. Favorable outcomes can result in reduced costs and increased revenue, while unfavorable outcomes can lead to increased expenses and decreased revenue. In conclusion, the primary drivers of revenue growth or decline for a company are multifaceted and interrelated. A combination of regulatory environment changes, product sales, customer relationships, financing, and litigation outcomes all contribute to the company's financial performance and revenue streams. The net income of a company has experienced significant fluctuations over time. Initially, it was consistently negative due to substantial expenses, resulting in an accumulated deficit of $3.7 billion as of December 31, 2025. However, there was a slight increase of $0.8 million in 2025. Nevertheless, the net income decreased due to various factors such as RIPA expense and embedded derivatives valuation losses. The profit margins have also undergone changes. They initially decreased due to mandatory discounts or rebates required by government healthcare programs and private payers. Furthermore, they were expected to decrease due to government agreements with pharmaceutical companies and measures that increase generic and biosimilar drug entry. Additionally, the profit margins decreased due to potential reductions in reimbursement from Medicare and private payers. The reasons for these changes are multifaceted. Reduced Medicare payments to providers, increased rebates for Medicaid programs, and potential price negotiation provisions in the IRA have all contributed to the decline in net income and profit margins. State-level legislation controlling pharmaceutical pricing has also had a significant impact. Moreover, mandatory discounts or rebates required by government healthcare programs and demanded by private payers have further reduced profit margins. The company's debt level has undergone significant changes over the past year. Initially, there was a notable increase in total debt from $871 million to $1 billion due to the combination of two promissory notes and an extension/modification of existing promissory notes. This was followed by a decrease in debt, with a gain on extinguishment of $82.9 million in August 2022. However, this reduction was offset by subsequent increases in debt levels, resulting in a total debt level of $1.23 billion as of the latest reporting period. In terms of interest expenses, there has been a mixed trend over the past year. While interest expense decreased by 47% from -$114,670 in 2024 to -$60,985 in 2025 due to lower outstanding balances of related party debt. Other sections indicate that interest expenses have likely changed significantly due to increased total debt and changes in interest rates. Furthermore, non-cash interest expense related to revenue interest liability increased by $41.2 million in 2025 compared to 2024. Overall, the company's interest expenses have undergone notable fluctuations over the past year, with some sections indicating a decrease while others suggest an increase. The performance of various segments and regions in the market has been a mixed bag. On the positive side, the U.S. region has shown significant growth, with notable achievements in building sales and marketing infrastructure, generating revenue, and establishing commercial distribution channels. The EU region has also made progress, with conditional marketing authorization being granted. In contrast, international markets have faced challenges, despite receiving regulatory approval. The uncertainty surrounding government policy decisions and the potential for unsuccessful commercialization efforts pose significant risks to these regions. Furthermore, other product candidates in the pipeline are not expected to generate additional revenue unless they receive regulatory approval. Management is optimistic about the company's outlook despite expecting revenue to take time to generate. They anticipate a significant increase in operating expenses due to ongoing development activities and commercialization efforts. To support these efforts, substantial additional funding is required for continuing operations. The company has a strong cash position with $242.8 million in cash and marketable securities as of December 31, 2025. However, management expects to need more funding due to increasing operating expenses and potential regulatory requirements. Key factors that will impact future funding requirements include commercializing Immunitybio and other products, research and development costs, regulatory approvals, revenue from potential products, and manufacturing facility costs. Management is focused on commercializing Immunitybio for sale in the U.S. and globally, prioritizing regulatory approvals for product candidates, and mitigating concentration of credit risk in convertible note receivable through conversion option. They believe that existing cash and potential support from key executives will be sufficient to fund operations for at least 12 months. Overall, management is aware of the company's financial situation and is taking steps to address its funding requirements. While there are challenges ahead, they remain committed to driving growth and success in the market. The company has made several strategic acquisitions and divestitures to enhance its portfolio and financial position. In terms of acquisitions, the company has strengthened its Cancer BioShield platform by acquiring technologies that complement its product candidates. It also acquired a leasehold interest in the Dunkirk facility from Athenex, as well as Alter, VivaBiocell, and GlobeImmune. Additionally, the company exercised an option to purchase the Dunkirk facility at a nominal price of $1. On the other hand, the company has divested certain assets to optimize its financial performance. Specifically, it sold revenue interest to Oberland for $200 million in 2023, with the possibility of selling additional revenue interests for another $100 million upon satisfaction of certain conditions. Furthermore, the company converted 2 promissory notes worth a total of $230 million into shares of common stock in December 2024. These transactions demonstrate the company's efforts to streamline its operations and improve its financial flexibility. The company has not paid cash dividends in the past or future, indicating that it prioritizes retaining earnings for growth rather than distributing them to shareholders. In terms of share buybacks, the company has been active. Notably, it repurchased shares through CVRs issued during its 2017 acquisition of Alter. Additionally, a significant number of shares were bought back under a program approved in 2015, with $18.3 million remaining authorized for future use. This suggests that the company is committed to reducing its outstanding share count and potentially increasing earnings per share. That concludes the financial summary for Immunitybio Inc. Feel free to comment below, and I will be happy to answer them when possible.